While the big news this week, of course, is the RBA interest rate announcement, there's been lots of other news in the media that Dr. Andrew Wilson and I discuss in this week's Property Insider Chat, including the latest jobless figures, where there's been a huge surge in employment growth, lots of jobs created and unemployment remaining low, despite all the challenges in the world. We talk about the home loan approval data, which gives us a good indication of what's ahead for our housing markets. Of course, we discuss the auction results, and the fact that Melbourne is now forecast to reach 9 million people by 2050, and a suggestion that maybe you should get in before another 4.5 million people do. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you updated each time a new show comes out. Australia's housing markets continue to power through 2025 with strong undercurrents beneath the surface, some steady, some sinking. Now, this is going to be a big week for property because by the time you watch this week's Property Insider Chat, the Reserve Bank's already going to have made its decision on interest rates. Clearly, it's much indicated that the Reserve Bank will drop interest rates at its meeting, meaning the tailwinds for property look to strengthen. Because if the Reserve Bank does drop interest rates, borrowing capacity will improve, buyer competition will increase, demand from both investors and upgraders is likely to build. I guess that'll also be because there'll be extra confidence. But we should also remain cautious, as you're going to hear today from Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. I also want to ask him about the latest unemployment figures, home loan approvals, and as always, let's discuss the auction clearance results to see what's happening in the markets. Hi, Andrew.
Yeah, good day, Michael. And as you said, a big week coming up. With the Reserve Bank meeting. Certainly the jungle drums have been beating very loudly that we're going to get another cut following the February cut, and some have even predicted 0.5% perhaps. I think that was a bit of wishing and a hoping and a praying from the banks at 0.5% forecast. I'm not sure it's completely locked in, the interest rate cut, but certainly most experts are predicting a cut. But, you know, we still have a very strong economy, and we're still a little lower with our interest rates from the US. And, you know, we want to leave a little bit in the in our supply line for stimulus, just in case we need it.
Well, we'll find out real soon. In the meantime, though, let's have a talk about what has already happened and we can give some commentary on. And despite all the global economic turbulence, Australia's job market remained remarkably resilient over the last couple of months, the latest figure showed.
Yeah, we sort of felt there was perhaps signs of weakening in what is a strong labour market. Jobs were down 2 months ago, but and then the following month jobs picked up again, but and not at the rate we'd seen, but it was a big result over March, sort of following on what we've seen for most of the past year or so. The unemployment rate steady at 4.1%, which is an inarguably low unemployment rate historically. Jobs surged up 89,000 jobs over the month, Michael, which is a very big number. Unemployed numbers were also up 6,300 over the month, but the participation rate increased from 66.8% to another near record 67.1%. We're still soaking up all the spare capacity we have in our potential labour market, and this can only have been perhaps the two better months that we've had recently. It can only have been reflected by lower interest rates, and of course, if we do get an interest rate cut this week, Michael, it will only help the labour market continue to be strong. New South Wales, South Australia were lowest for the jobless at 3.9%. And, you know, just absolutely no signs of a shakeout in the labour market, Michael. It keeps on keeping on. And it's interesting if we look at the international commentary, the Powell, who, of course, is the US Fed chairman, the central bank chairman of the US, is in recent commentary has said that he's starting to look a little bit more closely at the labour market in terms of interest rate policy settings for the US. Of course, we've been focusing on inflation, which got as high as it had for since the early 70s because of those stimulus packages, the COVID stimulus packages, and we've sort of forgotten all about to some degree, the labour market, because labour markets have been strong as a result of those stimulus packages. But he's saying now that, you know, we may have to start refocusing on what's happening in the labour market, which did used to be the main driver of interest rate policy, But so it's a timely result given how strong the March figures were.
Healthy labour market's good for our housing markets, of course, Andrew, especially homeowners and borrowers. It gives them confidence to make financial commitments. Obviously, it also keeps mortgage arrears low. I remember a while ago there were those stories about the cliff that people couldn't keep up their mortgage payments because of unemployment. It also supports rental demand from a mobile workforce. So as long as employment remains robust, it's unlikely we're going to have any downturn in our housing markets.
Yeah, whatever happened to the cliff, Michael?
Yeah.
That was a good story for 5 minutes. But I think that the only real clouds on the horizon for the housing market do come from a shakeout in the labour market because, of course, people will curtail their spending habits if they lose their job or if there's concern over job security, and higher unemployment usually leads to lower wages with less competition for labour, as we have strong competition at the moment with these high participation rates. So, but of course, if the labour market gets to a point where the Reserve Bank is concerned, they usually step in and cut rates, which, as you mentioned, is always a clear driver of increased housing market activity. So no sign of weakness in our labour markets at the moment, Michael.
When we look at your chart about where it is, though, various states have created more jobs than others. Western Australia still powers along, doesn't it?
Yes, it does, but they're all pretty reasonably just above 2%. But yes, Western Australia, the strongest for jobs growth over the year. I think I said March before, of course, these are April figures, and up by 3.1%. When we look at the historical unemployment rates, Michael, it sort of brings home that this is still a very strong labour market because we're tracking around about our lowest points over the last 20 years and around about where we were in that great mining boom of the noughties, so it's a very strong result again. And the jobs growth figure was really, quite spectacular.
Very strong, wasn't it? Sure. Let's have a look at the latest lending figures. We keep a track of those, Andrew, because it gives us an indication of how many people are going to be in the market moving forward. What's the latest home loan data shown?
Well, we now have, we used to get monthly figures on home lending, Michael, but the ABS have now decided to do that over a quarter, which is a bit of a shame because home lending data is a very good correlating measure of what's happening in the housing market, obviously. And it also gives us the insight into breaking down buyer types. We can look at what's happening with owner-occupiers, first home buyers and investors. It has been a very useful monthly data set, but now we have the quarterly data set, but we can still, glean some insights into those breakdowns. But when we look at the latest figures, home loans are actually down over the March quarter, down by 3.5% over the quarter. But we need to make mention that these numbers, even though that's seasonally adjusted, Michael, are affected by seasonality. There's no doubt about that. So no surprise to see March falling compared to December, even though we did have that February interest rate cut, which wouldn't have been really tracking importantly as a driver with those March quarter figures. But when we look at the year-on-year figures, it gives us a better sense of how the loan market is tracking, with total home loans actually up by 6% over the past year, Michael, and that's the seasonally adjusted data. So once we take the seasonality out of it by comparing it with the same time last year, we can see that there's been quite a significant lift in home lending. And we're still not back to where we were at the peak in the middle of 2021, Michael, in terms of the underlying volume of home lending for owner occupiers or for total homes. But we're certainly starting to track upwards, and of course, with lower interest rates, perhaps potentially again in May, and the fuller impact of the February cut, I'd expect to see those numbers start to rise, continue to rise for home lending. But when we look at the breakdowns in the buyer types, we can see all buyer types were down over the quarter compared to the previous quarter. Owner occupiers down 3.4%, investors down 3.7%, first home buyers down 4.2%. But as I said, in relation to the total figures, when we look at the annual breakdowns, it gives us a better sense of how the market is tracking in a comparative sense. Owner occupiers down 4.4%. First home buyers down 1.3%, but investors, Michael, are still very strong in the marketplace, up by 8.8% over the year. Some, very encouraging and not surprising results from investors that continue to move into the market to take advantage of higher prices and higher rents, Michael. So some validation there for that ongoing interest in housing from investors. And when we look at the breakdown in terms of how the states are performing, as usual, Victoria is the top performer for owner-occupied loans, followed by New South Wales and Queensland. And when we look at the growth levels for owner-occupied loans over the past year, we can see that Queensland was the top performer, up by 5.9%. So strong growth in Queensland owner-occupier loans, but no surprise given how strong that Queensland and particularly the total Queensland market is really, but particularly the southeast Queensland property markets, housing markets. New South Wales, as usual, the tops for investor loans, so well and truly ahead of everywhere else. Interesting, Queensland is in second position following New South Wales, ahead of Victoria, so more investor loans being taken out in that Queensland market. And when we look at the growth over the year, we can see reasonably similar between Victoria, Queensland and South Australia. South Australia, the leading performer, up by 13%. Some forward-looking or another part of the evidence that the Perth market is starting to ease, with Western Australia's annual investor loan growth falling by 1%. But still, good results there from Victoria and Queensland, up by 12%. So Victoria, Queensland and South Australia, and of course South Australia is coming from a lower base in terms of the actual numbers of investors, but certainly investor activity on the move still in most of the states, Michael, exception being Western Australia.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Yes, well, Western Australia seems to be showing it's slowing down a bit in a number of ways now. We talk about the auction results every weekend, Andrew, because it gives us an indication of how buyers and sellers are feeling at the moment. We're now clear of all those distractions of a month or so ago. We're leading up to a period of a number of good weekends of large auction numbers, and Melbourne has once again shown outstanding strength.
Yes, Michael, that's why we look at these auction results every week, because it gives us a very reliable forward indicator of underlying energy in our housing markets, and it's proven to be over a number of years a reliable source of insights into the housing market. And it was another big weekend for Melbourne. This is 3 in a row now for Melbourne, leading all the capital cities in terms of the clearance rate and the number of auctions. And we are, as you said, we've got all those holiday distractions, election day distractions behind us now. So we've got a pretty clear run for the next 3 or 4 weeks until we move up to the King's birthday long weekend. So it's a real test for all the markets. And again, we're continuing to see Melbourne lead the pack. And I guess we could see a one-off better result, which we can then sort of look to build on. But Melbourne's certainly built on its better results over the past month. So it's no longer, I guess, speculative in terms of the growing energy in that Melbourne market, which we know has been an underperformer for the last couple of years. And as we've been saying here, Michael, it's really been due, and certainly an opportunist market, and perhaps those the comparative value in the Melbourne market is finally starting to attract buyers. But the auction data certainly supports it. Melbourne had a clearance rate of 74.1% at the weekend, which was similar to the 74.6% the previous weekend. More auctions were conducted in Melbourne. Sydney also had a solid, robust clearance rate, 73.6%. Auction numbers very similar again to the weekend before, 667 versus 661. And I think the real story in the data, Michael, is not just the past 3 weeks in Melbourne, but also when we compare Melbourne to where it was a year ago. And it's now tracking at around about 10% higher than where it was a year ago. And our forward tracking on house prices in Melbourne is actually showing that it's now on the cusp of showing some annual growth in house prices as well. So all these things are certainly converging now in terms of indicating a promising second part of the year for the Melbourne market. But certainly the auction markets are up and running in Melbourne. Brisbane week, bigger weekend for auctions in Brisbane. Clearance rate was similar with a high 40 there, which is the usual result for Brisbane, around about 50%. Adelaide down a little bit with similar auctions, 57.5%. And Adelaide's a bit different to Melbourne. It's moving the other way. Its auction clearance rates are well below the very big numbers it was recording a year ago. And Canberra, a bit of the same old in Canberra. Auction clearance rates just above 50%, lower than the week before, and auction numbers similar to the week before. And that Canberra market, unlike the Melbourne market, is continuing to, produce subdued results going forward. When we look at the trends, it's quite clear that the Sydney market is a seller's market at the moment in terms of the auction clearance rates. Has been tracking above 70%, consistently above 70% this year, and holding at the levels of around about a year ago. And when we look at the longer term chart for Melbourne, you can clearly see how that Melbourne market has built up this year and is well ahead, 10% ahead of where it was over the same period last year. And it was only really the lower Easter results through April that kept the clearance rate down in Melbourne. And now that we're getting back to normal listing numbers in Melbourne, we can see the reality of the clearance rate, which is now, you're looking at pushing up towards 8 out of 10 properties selling under the hammer in Melbourne. And once we get to that, we really do know that there's some significant energy in the Melbourne market. Brisbane down on where it was a year ago, but a year ago it was recording record clearance rates for the Brisbane market. Adelaide's fallen away compared to where it was a year ago. So even though we're still seeing some prices growth in Adelaide, Michael, its clearance rate is certainly not at the levels as it was a year ago. And that Canberra market continues to sort of trundle along around about the 60%, just under 60% mark. And we can't really herald any breakout in the Canberra market with the current figures. And of course, if you're looking for those auction clearance rates every Saturday, they can be accessed on my LinkedIn channel, which is Doc Andrew Wilson at LinkedIn. And that's for the capital city results, hot off the press. And Michael produces on his various channels the national report on Sundays, which includes the regional breakdowns for Melbourne and Sydney, and also the top 10 auction sales under the hammer. So a very productive week again for the auction market, Michael. We continue to focus on Melbourne over coming weeks. Will it be sustained? And of course, in terms of auction markets, an interest rate cut will only bring out more buyers, which will mean higher clearance rates going forward. But we wait and see on the result of that coming up.
When we get together next week, we'll know that result and we'll be able to give our thoughts on what's ahead for our housing market. But overall, the markets are showing strong fundamentals, and Melbourne in particular seems to have shifted up a gear or two. Let's see if that continues, Andrew.
Yeah, well, the figures are certainly very promising for that Melbourne market. But as I said before, Michael, we've been sort of predicting this in a way, yes, haven't we? Because there's really been no significant reason why the Melbourne market has been a clear underperformer other than confidence. Its economy is still quite robust. I think the value aspect of the Melbourne market finally gets buyers up and running, and it becomes a question of fear of missing out rather than fear of being involved.
Well, over the last week, the state government has changed its forecasts and are now suggesting we're going to have 9 million people in Melbourne by 2050. In other words, the size of New York today by then. So I guess my advice is get in before those other 4.5 million people do, because they're going to push up property values.
Well, that's right. And as we keep seeing with our building approval data, which is very important to look at every month as we do, we're really not matching supply with demand.
No.
at current levels, much less at higher prospective levels.
Thanks. Catch up with you again next week, Andrew.
Thanks, Michael.